On January 14th, 2026, something happened that most people missed entirely. Not a crash, not a rally, not even a tweet. A proclamation. Specifically, presidential proclamation on adjusting imports of processed critical minerals and their derivative products into the United States. The market barely blinked. Silver dropped hard, then bounced, copper whipsawed. Then everyone went back to watching their screens. But here's what actually happened that day. The United States government just activated a 180-day countdown clock. And when that clock runs out on July 13th, 2026, the entire pricing structure for critical minerals, including silver and copper, could look completely different. Not because of tariffs. Those aren't coming yet. Not because of quotas. Those aren't the first tool either. Because of something far more structural. Something called minimum import prices. Price floors. And if you don't understand what a price floor actually does to a market, you're about to find out why the first move in silver and copper might be the smallest move we see all year. This is the story of how a government decides it will no longer tolerate being held hostage by foreign supply chains. How a single proclamation can reshape pricing for materials that power everything from your smartphone to the electrical grid. And why the real deadline isn't day 180. It's the moment when buyers decide they can't afford to wait. Let's start with what actually happened, because the proclamation didn't materialize out of nowhere. On April 22nd, 2025, the U.S. Commerce Department initiated something called a Section 232 investigation. Section 232 is a legal mechanism from the Trade Expansion Act of 1962 that allows the government to restrict imports if they threaten national security. Not economic security, national security. That distinction matters because once something becomes a national security issue, it stops being a trade negotiation and becomes a strategic imperative. The investigation focused on one specific question. Do imports of processed critical minerals and their derivative products threaten to impair the national security of the United States? Notice the word processed. This isn't about ore sitting in the ground. This is about refined metal, converted metal. Metal that's been transformed into a form that industry actually needs. Because here's the uncomfortable truth the investigation revealed. The United States is 100% net import reliant on 12 critical minerals. Not 90%, not 80%, 100%. For another 29 minerals, import reliance exceeds 50%. But the real problem isn't just reliance, it's concentration. China dominates the global market for processing critical minerals. They're the leading producer of 30 out of 44 critical minerals on the official US list. Let me put that in perspective. China doesn't just mine more rare earths than anyone else. They process them, they refine them, they convert them into the forms that manufacturers need, and they've spent decades building that infrastructure while the rest of the world outsourced the dirty, capital-intensive work of mineral processing. The Commerce Department's investigation lasted 6 months. On October 24th, 2025, Secretary of Commerce Howard Lutnick transmitted his report to President Trump. The conclusion was unequivocal. Processed critical minerals and their derivative products are being imported into the United States in such quantities and under such circumstances as to threaten to impair national security. Now, normally, a Section 232 finding like this leads to immediate action. Tariffs, quotas, trade restrictions. But Trump's proclamation on January 14th, 2026 did something different. Instead of imposing tariffs immediately, it activated a negotiation period. 180 days, until July 13th, 2026. During this period, the U.S. Trade Representative and the Commerce Secretary are directed to negotiate agreements with trading partners to adjust imports of processed critical minerals. And here's the part everyone needs to understand. The proclamation explicitly states that in these negotiations, the administration will promote the adoption of price floors for trade in processed critical minerals and their derivative products. Price floors, not tariffs that add a percentage on top of whatever the market price happens to be. Price floors that establish a minimum acceptable price below which imports cannot enter the United States. Most people hear price floor and think it's just another form of tariff. It's not. A tariff is a tax. You can still import cheap metal, you just have to pay extra. A price floor is a gate. If your metal is priced below the floor, it doesn't come in. Period. Let me explain how this works in practice. Imagine the U.S. negotiates a price floor agreement with its allies. Let's say they agree that processed copper products cannot enter the U.S. market below $10,000 per ton. Now, if a foreign supplier wants to sell into the U.S. market at $9,000 per ton, maybe because their government subsidizes production, maybe because they're dumping excess capacity, maybe because they're trying to destroy Western competition, they can't. The cheapest supply disappears overnight. Not because the copper vanished, because the rules changed. And when the cheapest supply disappears, everyone competes for the next cheapest supply. That's how floors lift the entire price curve without a single new buyer entering the market. But here's where it gets interesting. A price floor isn't just a number, it's a system. You need reference pricing to determine what qualifies. You need documentation to prove origin and cost structure. You need audits to prevent fraud. You need penalties for misreporting. And you need anti-circumvention rules, so companies can't just relabel products and sneak them through a different category. Building that system takes time. It takes coordination. It takes enforcement capacity. And once it's in place, it creates winners and losers. If you're an allied producer, transparent, and already inside the preferred supply network, the system becomes a tailwind. Suddenly, you're competing on a more level playing field because artificially cheap imports can't undercut you. If you're outside that network, the system becomes a wall. Now, the proclamation doesn't mandate price floors. It says the U.S. will promote them in negotiations. But here's what that really means. The administration is signaling to allies, we're willing to guarantee you a minimum price environment if you commit to reliable supply. We'll protect your producers from predatory pricing. We'll create the conditions for long-term investment. And to adversaries, the signal is different. Either you participate in this negotiated framework, or you face the alternative. What's the alternative? The proclamation is very clear about this. If satisfactory agreements are not reached within 180 days, or if agreements are not being carried out effectively, the president may take other actions deemed necessary to adjust imports and eliminate threats to national security, including, but not limited to, minimum import prices and tariffs. Translation: we're giving you 6 months to come to the table. If you don't, we have other tools. And those tools aren't gentle. Now let's talk about why this is happening right now. Because timing in geopolitics is never accidental. On December 3rd, 2025, China announced new export controls on antimony, tungsten, and rare earth elements to the United States. This came after similar restrictions on graphite in December 2024, but the really significant move came on January 1st, 2026. China implemented a new licensing framework for silver exports. Under the old system, China used quotas. Under the new system, exporters must meet stringent criteria: produce at least 80 tons of silver annually and secure $30 million in credit lines. Only 44 companies were authorized to export silver in 2026-2027. For tungsten, 15 companies. For antimony, 11 companies. These aren't quotas in the traditional sense, they're permission lists. And when you control who can export, you control the flow. You control timing. You control leverage. China's strategy is clear. They're not banning exports outright. That would trigger immediate retaliation and push countries to find alternatives faster. Instead, they're creating a controlled release valve. They'll sell to you, but on their terms, at their pace, through their approved channels. And if you do something they don't like politically, like Japan did when it restricted dual-use technology sales to China in December 2025, they can simply stop approving export licenses for rare earths, which is exactly what happened. Japanese companies that depend on heavy rare earths for electronics and magnets suddenly saw their shipments suspended. Not officially banned, just delayed indefinitely. This is economic statecraft, and the United States is now responding with its own form of economic statecraft. The 180-day negotiation period is designed to build a counter-coalition, to bring allies together around a shared framework that reduces collective dependence on Chinese processed minerals. On January 12, 2026, U.S. Treasury Secretary Scott Bessent convened finance chiefs from the G7 plus the European Union, Australia, India, South Korea, and Mexico. Together, these countries represent about 60% of global critical mineral demand. The stated theme was urgency. Frustrated by what he described as a lack of urgency, since a G7 action plan was agreed last summer, Bessent pushed for concrete coordination on critical mineral strategy, including the possibility of price floors to stimulate non-Chinese rare earth supply. Think about what's actually being proposed here. A coordinated bloc of Western and aligned nations agreeing to minimum import prices, creating an incentive structure that makes it profitable to invest in non-Chinese processing capacity, essentially guaranteeing returns for producers who build supply chains outside of China's orbit. This isn't free market capitalism. This is industrial policy. And whether you think that's a good thing or a dangerous precedent depends entirely on your perspective. But here's what's indisputable. Once governments start intervening in pricing for strategic materials, the old rules no longer apply. Let's zoom out for a moment and talk about why this matters beyond geopolitics. Because there's a supply crisis brewing that has nothing to do with trade wars. In August 2025, the U.S. Geological Survey published its updated methodology for the critical minerals list. Using an economic model that quantified potential effects of supply disruptions on U.S. GDP, they recommended adding 6 minerals to the critical list. In descending order of risk: potash, silicon, copper, silver, rhenium, and lead. Notice what's on that list. copper and silver, not exotic rare earths that most people have never heard of. Copper and silver, metals that have been industrial workhorses for over a century. Why are they suddenly critical? Because demand is exploding while supply struggles to keep pace. Copper is the bloodstream of electrification. Every data center build-out, every grid upgrade, every electric vehicle, every industrial modernization plan requires copper. It's irreplaceable for most applications due to its electrical conductivity. Bloomberg NEF's December 2025 outlook warned that copper demand for the energy transition could triple by 2045, and that the metal may enter structural deficit as early as 2026. Let me repeat that. Not 2030, not 2040. This year. The predicted deficit by 2050, 19 million tons. Now look at what happened to copper prices in 2025. The metal posted its biggest annual gain since 2009, of nearly 40%. Disruptions at major mines drove the rally. Indonesia's Grasberg mine had to halt deliveries after a fatal landslide. Chile saw worse than expected production at Collahuasi and Los Bronces. Peru faced its own operational challenges. At the same time, U.S. buyers went on a preemptive copper stockpiling spree in 2025 when Trump first threatened tariffs on imported metals. Even though those specific tariffs were ultimately suspended, the rush to hoard copper created pockets of scarcity and kept premiums elevated. And here's the uncomfortable part. High prices haven't triggered a surge in new mine development, because building a new copper mine takes 10 to 15 years from discovery to production. The permitting alone can take 5 years in most jurisdictions. The pipeline of new projects is weak. Investment has been chronically insufficient, and the easy deposits have already been found. Silver faces a different but equally structural problem. In late 2025, the U.S. government officially designated silver as a critical mineral, not just industrially useful, critical. Why? Because silver is essential for photovoltaic cells and solar panels. Each panel requires approximately 10 to 20 grams. Global solar capacity already exceeds 1,500 gigawatts and continues growing at double-digit annual rates. Silver consumption is expected to surpass 200 million ounces annually by the end of 2026, driven primarily by solar demand. But it's not just solar. Silver is used in electronics, semiconductors, 5G infrastructure, AI data centers, and medical devices. Unlike other metals, its properties are extremely difficult to substitute. Attempts to replace silver with copper or aluminum in high-performance applications consistently result in performance losses. On the supply side, inventories are collapsing. Silver inventories in Shanghai Futures Exchange warehouses plunged to 715 tons by late 2025. That's the lowest level since July 2016, an 86% collapse from the 2020 pandemic peak. And in May 2024, silver broke above $32 per ounce for the first time in 11 years. By December 2025, it hit record highs. Some analysts are now forecasting a test of $100 per ounce in 2026, with a potential move toward $250 to $300 if the breakout continues. Those aren't fringe predictions. Those are from market analysts looking at the structural supply deficit and doing the math. Here's what makes silver unique. It's both an industrial commodity and a monetary metal. It sits at the intersection of industrial demand and strategic demand. When policy touches silver, you get volatility from both sides. So we have a supply crisis, a geopolitical contest, and a 180-day countdown. But the real question is, what actually happens during those 180 days? Because this isn't just a timer, it's a psychological weapon. Month 1 will be confusion and positioning, allies trying to figure out what the U.S. wants, exporters lobbying for carve-outs, traders testing the boundaries with volatility. Months 2 and 3 will bring progress stories, leaked talking points, sudden optimism from unnamed sources, headlines that say, deal close on critical minerals framework. Markets will relax. People will assume the crisis is averted. That's when you need to pay attention to what's not being reported. Are companies signing long-term offtake agreements? Are mining projects that were previously stalled suddenly getting financing? Are defense contractors adjusting their procurement strategies? Because offtake agreements are where the future gets priced, not in spot markets, not in futures. In quiet bilateral contracts between producers and major buyers that lock in supply for 5 or 10 years. Months 4 and 5 will bring pressure, deadlines, threats, final offers. That's when the real buying often starts, not from retail investors watching YouTube, from institutions that don't want to be seen chasing price, but also can't afford to be caught without supply if negotiations fail. Then comes month 6, July 2026. If negotiations succeed, you get a framework. But don't assume a successful negotiation means lower prices. A negotiated deal can still include minimum acceptable pricing provisions. It can still include commitments to avoid dumping. It can still include coordinated stockpiling. It can still include voluntary limits that function like restrictions. In other words, A deal can be the mechanism that legitimizes the price floor. If negotiations fail or stall, the administration has already signaled it will use other tools. Minimum import prices. Section 232 restrictions. Potentially broader actions that won't be spelled out in a press release. And here's the critical point everyone needs to understand. The market won't wait until day 180 to react. The market will start pricing in the most likely outcome sometime around day 120. Maybe earlier if something breaks in the negotiations. So the real deadline isn't July 13th, 2026. The real deadline is the moment when large buyers decide they can't risk waiting. When manufacturers start whispering to their procurement teams, we should secure supply now. It's cheaper to lock in today than to gamble on policy tomorrow. That's when stockpiling begins. Not by governments, by the private sector trying to front-run the government. And that's when price can move in ways the charts can't explain.